as well as uh, Ministry of Electronics and IT. Then the reason behind choosing this topic, that is funding sources and fundraising, was this is a very, what we say, common yet complex subject which we always receive questions on. We how exactly this all works, why funding is required, right? The very basic questions to very complex questions, that those all will be covered today by our speaker. I will just tell a brief about our speaker. He is Mr. Rohit Goyal. He is managing partner at Windrose Capital. So his experience is close to decade. Past 7 years, he has been working with this firm and in this sector altogether. So we will take help of his expertise to understand all these questions and improve our understanding in this sector. So I welcome Rohit, sir. Over to you.
Thank you for the introduction, Aditya. Hello, everyone. Just to iterate, I am Rohit Goyal, managing partner at Windows Capital. We are the first and the oldest operating SEBI-registered VC fund based out of Pune, and we really believe, this is a great place to be in. Even though I know this session is not geographically limited, but I believe, or rather I assume, that most of the participants are geographically either located in Pune or their businesses is located in Pune, if not all. So great. Thank you everyone for joining in, especially on a Friday afternoon. So I can imagine weekend is just luring around the corner. What I'm going to do is I'm going to keep this session as interactive as possible. So as again, Akshay mentioned and Pradeep mentioned as well, that feel free to ask questions, raise your hands. Unmuting yourself to ask questions directly, I think we'll see how much of that also we could accommodate towards the end. But what I would like to do is, okay, I can see somebody's already raised their hand. So if that was just a try, it's okay. Else, Akshay, please check up with the individual. And yeah, what I'm going to do is, I have received a bunch of questions beforehand. I'm going to take a few of those which are fairly fundamental, just to sort of set some context. After a couple of minutes into that, what I would love to do is more answer questions by the participants directly. Feel free to make it as specific to your company as possible, but at the same time, one request: don't spend 10 minutes just asking the question, because others should also get the time to ask. So in the interest of making it specific for your company, please keep it short. That's the only sort of request. So just to begin, I'm going to outlay like the first three questions that I would want to answer. What are the different types of funding sources? What are the instruments to raise funds? And what websites or platforms to know for availability of interest of funders? So these are all basically questions in connection to the sources of funding. What are the types? What are the ways? And what are the avenues? Basically, broadly speaking, as in any form of capital, it's primarily two. One is debt or equity. So there are two types of funding sources, debt or equity. But having said that, it's not just that simple, right? So there is a lot of gray zone in between. So a debt is where you have to own up to repaying the investment, where upon a pre-agreed sort of rate of return. Whereas when it comes to equity, the investor or whoever is infusing capital is actually buying a portion of ownership in the company, right? So they are actually not looking for a fixed return as such, but are actually looking for like a much higher return as an owner in the company, and not exactly just as a lender to the company. Now there are a lot of things which come in between, right? So you have got convertible, which is the debt that converts to equity at a future date, or you could have debt that does not convert to equity but has some other rights or powers at a future date, so on and so forth. So like in between, you could play, but at the end of the day, it's you have to understand whether the capital coming in is taking the risk or not taking the risk. If it is not taking the risk, it is debt. If it is taking the risk along with you as a founder, it's equity, right? And as the nature of capital goes, your instruments also then are similar. Like you can have debt instruments or equity instruments. Uh, in equity instrument, usually you have variable or a convertible preference shares, so on and so forth. Just 1 second. Okay. Yep. Thank you. I think this setting makes a lot more sense. Yeah. Uh, so coming back to our point, when it comes to debt, usually debentures is the route which private limited companies have an option to do so. If you are incorporated as a partnership or an LLP, then debt primarily comes purely as debt. There is no defined instrument, so to say. With private limited companies, the benefit that you have is you could actually have a debt instrument today, which could convert to equity at a future date, and you may sort of define the terms or define the manner in which the terms of conversion could actually be then taken care of in future. Quickly, just since in interest of time and being aware of the fact that we are still just setting the context, uh, the third piece was avenues for raising funds, right? So again, there are different types of places one could go to depending upon the nature of or the type of capital that you are looking to raise. So for example, if it is debt, of course, banks, everybody knows, but there are NBFCs, there are venture debt funds which have come up in India, as well as there could be other private individuals, family offices who are open to actually extending debt. But usually debt is only offered to companies who can demonstrate the capability to repay it. Have, let's say, VC funds, PE funds. There are other players also in the market who actually invest capital against equity, who could then be tapped in through various sort of channel partners. Some you can approach directly, some you might have to get in a consultant or an investment banker in between to reach out to people. But again, that usually depends upon the size of transaction. Early stage or your first fund raise typically happens from angel investors or early stage VCs or family offices. These can, or actually, I personally recommend or I personally prefer the founders reaching out directly. Now, one needs to understand that while founders have that reservation, right? That, oh, if I don't know an investor, how will I reach out to them? But you need to understand at an early stage piece, the investor on the other side is also looking for good early stage opportunities. And as an investor, for me, if I say, okay, an early stage opportunity, if I am looking only within my direct network, I am limiting myself. So any good early stage investor will be more than happy to interact with people who are completely unknown to them. As in, most of the portfolio investments that we made, we did not know the founders from before we made the investment. We were introduced to them only for the purpose of the transaction, and not more. And that's also, like, as far as we know, the case with most of our peers, who are investing. Okay. Uh, yeah. So just sort of setting the context over here, would want to move into if there are any direct Q&A, and I think Dr. Saurav Kumar has raised his hand for quite some time. So Dr. Saurav, if I can hear your question, please.
Yeah, hi, sir. Myself, Dr. Saurabh. I'm a founder of a blockchain technology-based as a startup that is in the segment of arts and craft. Okay.
Okay.
We have developed our product. Okay, and it is already available in Android. Okay, and we onboard our artisans, others also. Okay, we are in the mode of pilot test learning, and we are developing the MVP already developed, and keep working on that one. Okay, so at present we have good some few numbers of research and done, but now we have all the things has been done by the bootstrapping. Now what we are thinking that we at least what is the high way to go for the approaching the investor for the early stage revenue, because we don't have much revenue. We are not having revenue in pre-revenue stage. Okay, and we are just in the stage that we can get whatever tractions from the market.
Correct.
We are running pilot running in one city like Patna, suppose.
Correct. So,
what?
I got your question. So basically, it's around how do pre-revenue companies go about fundraising,
Right, sir.
right?
Right.
Yeah. So
Right.
essentially, see, as I said, if it is pre-revenue, very clearly debt as an option is out of the way. So when you are going to equity, for equity fundraising, basically what one has to then look after is somebody who's buying into your company is actually buying a future of a business. So you have to make a case in terms of how sure or what will the business be, how will monetization happen, how much can it grow. So you have to now start showcasing that piece, right? So that this it is not just a idea or a concept, but it is actually a business. Now this is where a lot of early stage fundraising effort fails, because people start talking about what they have done, what efforts have gone in to come to the stage right now, which is all okay and good, as in with all due respect to that. But you need to understand the person who's buying in is not buying what you've already done, is buying into what this business could possibly be.
In future.
Now,
In
in that
future.
context, what in
Yeah.
future, yes.
In
So in
future.
that context, we
So
need to showcase, okay, this is the business case, this is what we are planning to do. And now, of course, the second piece would be that, okay, you might have a good business plan that could come out of thin air, right? I can say I am making a product or service, it has 5 billion users across the globe, and each of them is going to pay me $2 per annum, so I have a $10 billion market size, right? But now this is coming up completely out of thin air. Now, how do I demonstrate? So it's not just about putting up a business plan out there, but okay, if you're saying you can tap into 5 billion people, how will you reach out to them? What all strategies would you use? Have you tried or tested those strategies at a small scale? Forget 5 billion people. If before reaching 5 billion people, how will you reach the first 500 people? Let's speak of those. Have you even attempted reaching out to first 50 people? Maybe the product is not ready to be used yet. Maybe the product is still under development, but what is the sort of customer feedback you are getting even before they've started paying you? So remember, customers actually give you two valuable things. Money is one, but the second most important thing at an early stage is feedback, and which is helping you improve your product every day with every feedback. And I believe the more you do that, inherently the value of your product keeps going up, because the more feedback you've gotten, the chances are the more your product or service is suited for the market. And then there would be more takers for the market. You might have early signals, right? You might have some early customers who speak about, okay, if you are able to achieve this piece, or you're able to deliver up to this quality of or this standard, we will buy your product or service. Now, if you at least have those expression of interest or those early indicators that, okay, if only I can put in this much money, get this product from here to here, and then I have customers, like, giving me this much amount of value out there. Now, that is the case which somebody will buy into. So a lot of times I've seen this happen, that founders come to investors and they speak about how much effort has gone in to come where they are. While that is good, if if that was the basis to actually invest in the company, I would then simply ask, okay, what is your revenue today? If it is 1,000 rupees, I will say, okay, then if your revenue is 1,000 rupees, you are valued at this much, and I will pay you this much for XYZ percentage, because you've only spoken about the past. So then I only need to look at the past, right? This is the effort that has gone in, this is the outcome that has come in. But if there is a future to it, which is much bigger than what it is today, then we are willing to sort of invest in. Very good example would be, if I can, a lot of things are happening in the electric two-wheeler space nowadays. So and that's an sector that which we are also very keenly looking into, and we already have made a bunch of investments. Now there are about 200 plus electric two-wheeler manufacturers already, who are beyond your traditional guys like TVS, Hero, and like beyond the established incumbent players. 10 years or 5 years down the lane, 90% of those companies won't exist, right? But over half of these companies have ended up raising money. Now, investors also understand that as an equity investor, we might end up losing our money, but we are not investing in a company or a business to lose our money or to own a certain percentage stake. The idea is, out of these 200, maybe 10 or 20 new age manufacturers will come up who will be there to stay, who will be the next, let's say, the Honda, the Heroes, and the like
TVS,
and the lights,
TVS.
the TV, yeah, the TVS, and there are plentiful. Like if you go to the cycles,
Yeah,
there's Bajaj and so on and so forth.
yeah, Bajaj. That is but in the
Correct.
scenario they also transforming themselves. Okay, Hero is
Yeah.
also
So
coming in the electric segments.
no,
Everyone
of
is
course
transforming.
they are, but then there are a chance of Hero 2 coming up, or somebody else, like names that we don't know of. Like for example, right now Ather is one of those companies.
Ether, Ola is
Ola
a
Ola has
simple
entered
one,
the space, right? So these guys are new brands that are coming up.
and
Now the
Binance is
idea,
also come.
yeah, there are a bunch. As I said, there are 200 such names. I could name 50 right off the top of my head right now, of those, right? But then having said that, the idea isn't to be invested in 50 or 200 companies. The idea is, even if an investor ends up holding, let's say, 5% equity in a company which is in 5 years or 10 years time going to be the next Bajaj or the next Hero Electric, or the so are you understanding from an early stage investor's perspective? That reward is what they are chasing. They are not chasing what your current numbers are specifically. They are chasing, can you be the next large person? And if so, then there is risk appetite for people to be invested in. Now what I've often seen happen is founders get so much busy telling their journey till now that they forget to emphasize on journey from this point to future. And an investor is not buying your past, he's actually buying into your
Buying
future.
your my future, right?
Yes. So if the stronger
And
the
one more
case
thing,
you could make, yeah.
one more thing. See, for that we need certain type of guidance, mentorship. So where should we have to approach for the accelerator program? There are some accelerator programs running around that one in India, but we find at least some of accelerator program is very good, which can actually guide the startup in the beginning stage. Okay, and that
So
is very
that
much
is
required.
where incubation centers, very much like AIC-Pinnacle, come into play, right? So that is why they are called incubation. So if you understand incubation, the word comes out of like an egg before it hatches. It
Yeah,
is
right,
incubating,
right,
right?
right.
So it is when the idea is still at an idea stage. So an incubator or an accelerator are places where you actually go with just an idea, and they help you connect and network with places around you. And there are many such incubators across the country. In Pune, AIC-Pinnacle is one of the good ones as well, and you guys could actually look up for others as well, as in it's just a
How can I
Google
approach
search.
them, sir? How can I approach AIC
As
people?
I said,
Oh,
so Aditya, I think they are the one
yes,
who
yes,
organized the event.
yes.
So
We'll share our contact details at the end of the session.
okay,
In chat box.
fantastic. So their
Please share
contact
the contact.
details,
Yeah, yeah. Please share the contact details.
lovely. I see there is one more hand up, Mr.
Yes,
Anil.
yes, yes, Anil sir.
Yeah.
Yeah. Hi, Rohit. So my question to you is, how do I value my startup? Let's say it's in different stages as yet. So before I come to the equity part or the debt part, I would like to find out what is the current valuation of my company. If it is in an idea stage, if it is in an early traction stage, or if a market, a viable product is ready commercially. So how do I value my company?
Uh, very honestly, Mr. Anil, at an early stage, and my community probably hates me for saying this out loud in public, but valuation is an art. It's not a science at early stage, because you just don't have enough reliable data to actually crunch the numbers. Uh, Again, okay, we spoke of. I'll go back to the two companies we spoke about while answering my previous question. Right, one was Ather, the other was Ola Electric, right, which came out with the motor with their two-wheeler very recently. But if you know, Ola Electric hit a $1 billion valuation even before earning a single rupee. Uh, Ather is still like, it has had its own journey of multiple rounds of fundraising after having had its product designed, approved, pilot batches made, so on and so forth. Now we are seeing two companies in the exact same space, one more mature than the other, but the one which is nascent has gotten much higher valuation than the one which is mature, right? The point I'm trying to make over here is, at an early stage, valuation is anybody's guess. It's how you value yourself, how you put forth, and more importantly, how, like, let's say if I am Ola tomorrow, if I can say that, you know what, if I decide to, let's say, start manufacturing rickshaws also, and say ki Ola ki jo rickshaws aate, that will be made by Ola only, and I will be the largest three-wheeler manufacturer in the country. Now, just because there is so much conviction that I can achieve that dominant position because I'm Ola, suddenly the day I start that business plan, I would actually be valued more than, let's say, Bajaj Auto three-wheeler segment, right? Which is the leading manufacturer for rickshaws today. So it's just because when Ola says it, they already have the network, the experience, the capital, the bandwidth to be able to do it. Now, the same story, let's say tomorrow I get up as Rohit Goyal, individual, and say, you know what, I have studied this market for 10 years and I want to start something, blah, blah, blah. Now, maybe I might not get $1 billion valuation. I might get a $10 million valuation, like probably 1% of that, right? But now let's say it's not even me, it's somebody I know who said, okay, you know what, this space looks interesting. I haven't done any work in this before, but let me start creating something and let's see where this goes. Now that person might get a valuation of 1 crore or maybe like 1% of whatever I was to get, right? So it's actually not at an early stage. It's a much larger function of why you, and if you are able to answer that, okay, why is this founding team the best founding team to run the business model that you are running, then you don't have trouble justifying why you would be a market leader. And the moment you can justify a dominant position in the market, it is much easier for you to then go for a better valuation, just because you can say my market is so huge, I am poised to become the leader, if not the leader, let's say among the top 5 players. And depending upon the size of my market, this is the potential that I have. And now one needs to realize one big thing, right? So I've seen companies do this part also, and then they come back and say that, you know what, my business says that I'm going to earn 100 crore rupees 5 years from now. I have done zero revenues, but I want to value myself at 100 crores. Now, while that might sound logical because, okay, you are saying that is the earning I'm going to make. I have run a NPV formula, and I've got the net present value to be at so many crores, so on and so forth. And there, let's say you've discounted that, okay, 100 crores after 5 years, if I discount it by 15% year on year, thumb rule basis, I might end up getting a 50 crore valuation right now. But as an investor, if let's say I was on the other side, and I would say, okay, so which means if you achieve all your goals, I still end up making only 15% for the value that I've given you. And what if you don't end up hitting any of those goals? So there is no premium that I'm getting for any of those additional risk that I am taking as an investor in the company. So one would also have to look at it that even if you do a valuation and you do a discounted cash flow, whatever number that you come up with, that is the best case scenario for a debt investor, not for an equity investor, because a debt investor assumes ye sab to achieve hone wala hai. So where there is full certainty of inflows also. As an equity investor, there is not certainty of any business or anything. So the premium that you have to give is higher return, so to say, or prospect of higher return. In which case, whatever is your discounted cash flow value is, you discount that further by a much significant amount. And how much significant that amount should be is, as I said, is pure art. It's between how you are able to convince the person on the other side as well that you are the right one to run, like you are the right team, either be it like a one person like an individual or a set of founders who are to run the particular business model. Yes, Mr. Anil, I see your hand is still up. Yeah.
Yeah, thank you so much for that. Now I know how you think. So when I come to ask you for money, I know exactly what you will be thinking.
Yeah, I also negotiate hard, by the way.
Thank you so much.
So hence I always advise people to start at a good generous point, because I know that I'm going to bring bring that pole down drastically.
Great. Thank you so much.
Great.
Lovely. Thank you for the question.
Great insights.
Anilji. Yeah, so there was one more question. I believe it's a good time to take up from the pieces that were shared with me.
Yes, sir.
Okay, so in connection to valuation, right? So there was a question on what factors to be considered while calculating the company valuation and how to decide how much equity to give. Now, we answered the first part of the question around valuation, or I would say we attempted to answer that question. But how much of equity to give is also a very, very critical question, right? Now, I have seen things go both sides. Founders who've been very generous with giving away their equity, not having a lot left in their hand by the time the company was anything worth valuable. At the same time, I've also seen founders who've been too stingy when it comes to giving out equity, and thereby have actually not been able to capture a lot of soft value that they could have in the early days. So how much equity to give out is actually a function of, you need to understand that as a founder, right? For an investor, they are invested in 10 companies. As a founder, you are not the founder of 10 companies. Like I hope you are not the founder of 10 companies, any one of you all, right? So for you, it's a 0 or 1 game. Either you make it or you don't make it, right? But at the same time, from an investor's perspective, they have a portfolio. They have invested in 5, 10, 20, 50, n number of startups, right? It could, like, depending again upon the stage and size of the checks they write. So once that is sort of understood, you then have to look at one thing very, very simply, right? It's far better to own, let's say, 10% of a company which is valued at 100 crores as against owning 90% of a company which is valued at 1 crore, right? So while giving away equity, always ask yourself, what is it that you are getting back? Because as a founder, you are the last one who's going to get an exit from the company. So for you, either all the effort that you're putting into building the company is either going to fructify into a one, which is a fruitful exit, or it is going to go down the drain and be zero. There are only two outcomes. There is no mid outcome. There is no stable salary earning and still running in startup mode lifelong wala option. It does not happen, because you will run out of money at one point or the other. So you need to understand that there are two parts, right? So if instead of having 100% of the pie, let's say if you could give out 10% of the pie and be 15% more sure that your result or outcome is going to be 1 instead of 0. Now, this is a bit of a soft piece, right? So you need to understand how much value the person on the other side is also bringing to the table. And not just in the sense of money that they are putting in the sense of, so there could be people who could help you just ensuring that your business is success, and they may not end up putting any money whatsoever as well, right? But you can still give out sort of equity to them. Why? Because they are actually enhancing that whatever X percentage equity you give to them is actually creating a lot of value for 100 minus X, whatever remains, right? So there have been instances wherein, so you may have heard, right? There are companies that give out 1 or 2% to advisors or mentors who don't write a single rupee in check. And those companies do in future go ahead. They also raise larger round of funding. So it's not like investors are against it, right? Because there are much larger investors who are then after that also subsequently investing in the company, because investors also recognize that when it comes to equity giveaway, it's not just a function of money coming in, it's also a function of how much surety of success that person is bringing in. So if a mentor or an advisor can help you avoid mistakes that could cost you 10 crore rupees, it is all the more worth to give them 1 crore worth of equity today. And the beauty is the value of equity is in the eye of the beholder again. So you, as you set your valuation for your, let's say, investors, you could always say that, I am a large company because this is the surety that I'm going to reach there. You are going to help me reach there as an advisor or a mentor or whatever. And I think that there is one more question I had seen. There was a question around incubators, right?
Yes.
Aditi, can you just help me?
Yes. Like, are there any threats in giving some equity to the private or government incubation centers?
Oh, yeah. So there absolutely is not a threat in giving private or government incubators any equity. But one thing you need to always ask is, what is it that you are getting in return? Remember, when you're giving out equity, you're giving out ownership. When you're giving out ownership, you're basically making the other person your partner to some or the other extent. Now, if they are your partners, they have to bring something to the table, right? So be it private or government, or an incubator, an accelerator, or an advisor, or a mentor, whatever these terms are, right? So these are basically I would generalize that question to giving out equity to people who are not infusing capital. So or who are bringing in advice or bringing in the network or just bringing in the connect. So that, like, in fact, I would go even a step further, not at an early stage, but at mid stage or so, you'll also find there are people who are like, let's say, investment bankers who might help you raise capital and take a percentage fee instead, right? Now, usually there are people at mid stage or late stage wherein this fee also they are okay to take in the form of equity, like, or a mixture of equity or cash payout, whatever, right? So there again, there is equity going out without any capital coming in, because that is going in lieu of the services that they may have provided. So in these cases, you always need to look at what is the value on the table. And with equity, there could be methods in which you can sort of structure it in a manner wherein only after certain maturity event occurs would would that equity be vested. So you could actually structure those transactions as well, that okay, if ABCD conditions are met, then the equity transfer will happen. If ABCD conditions are not met, or maybe two of those three conditions, four conditions are met, certain percentage only goes out. So you can always discuss and negotiate on that front. Fortunately, there is much more flexibility while structuring equity transaction as compared to debt transaction, because debt is fairly simple. But with equity, you can be creative. And trust me, our laws are also opening up more and more. And we are at a point, as in, I wouldn't say we have the best laws as far as corporate structuring is concerned, but we are not far off. We are at a very good position there. So one should explore these things. One should always, I believe, use consultants or advisors, because they help you avoid mistakes, and they also help you sort of go ahead and sort of achieve what you want to do much faster. Like, of course, given if as long as you and yours and their interest is aligned. So one good thing about giving out equity is your interest gets aligned, right? If you're giving out equity to an incubator or an accelerator, they only make money if the company succeeds. Else that equity is worthless even for them. In fact, it's not worthless, it is burdensome, because there is some sort of compliance, etc., which will still have to be done. Imagine an incubator invested in 100 or 200 companies, all of them died, but the incubator still has to do compliance for 200 companies also. That cost in itself is a burden for them. So it's, nobody wants equity of a company which is dying or which is of no value. So be pragmatic, but there's absolutely no harm in giving out equity to incubators, accelerators, advisors, mentors, so on and so forth. I believe there's a question from somebody called Mahavir. Is that a genuine candidate, Aditya?
Hopefully, but before that, there is one more question, and the question is which are the right steps to get funding for early startups? Which are the general criteria set for early startups to get funds? These two questions.
Okay, so there are no set criteria for early startups. As I said, see, it's not a science, it's an art. Some funds have their own set of criteria. Some funds have a different set of criteria. Some individual investors have their own set of criteria. Now, one needs to understand, and this is a lot of times I've also seen this come up, right? So a lot of times founders feel that the criteria that are set and the criteria that are set are not really justified, or is not really. And at times there are founders who say, oh, in this one criteria, can you not take deviation, or can you take deviation, so on and so forth. So usually one has to understand that for an early stage investor, any professional or any organized early stage investors is actually setting criteria not by looking at the company, but is at looking internal to their operations and their method of working. So a lot of times the criteria may sound unfair to you, but it's only because the criteria were not actually designed for you. The criteria were designed for a investor. Now, just to give you an insight into it, like, let's say how we operate, right? So we have a website, windrose.capital. You guys could look it up. You can apply online. There is a application form, and we treat each application form, whether it is via reference, not reference, at the same level, right? So some might just go there, and apply. But we have our own certain criteria. Now we receive about 100 odd, let's say, leads every month now, and we end up investing in at max one company a month, let's say. So which means 99% of the leads that, or rather 99% of the companies that we meet, we end up saying no to. Now, operationally, if you sit in my position, would you optimize your organization to say yes, or would you optimize your organization to say no? If 99% of the mandates I receive, I have to say no to. So I would, of course, want to then optimize my own resource utilization as a founder myself, running a business in financial services sector. I would want to optimize it for my own operations, right? So I would look at, okay, what are the primary criteria I'm telling no to people from? And then I would just put them as eligibility criteria out there. Like, let's say, for example, again, this is not the case with us, but if I were a mid to late stage fund, right, I would not want to entertain pre-revenue companies. I will put a criteria that the company should have at least 1 crore of revenue before applying to me, right? That is just because I know that, okay, that eliminates 40 out of the 100 applications that come to me. So for me, suddenly my optimization becomes much better. Now, for you as a founder, it might appear, "Arey, ye bolne ke liye to fund hai, but if you want 1 crore revenue before I apply to you, why do I come to you?" So as a founder, sometimes people take it in a wrong sense, but what they need to understand is it's actually designed to optimize on the funds side. Now, and you would also see this, right? So startups, you may have a team of 10, 15, 20, 50, 100 people. How many funds do you know which have a team size of 20 people or above? There are hardly any. So आप लोगों को रिसोर्स शॉर्टेज होती है, उससे बहुत भयंकर शॉर्टेज हमारे यहाँ पे चालू है रिसोर्सेस की. So every fund is actually trying to also optimize for its own operations, for its own limited team and resources. You guys are aware how expensive they are in our industry, right? So like even in our organization, if we've ever had, fortunately, we haven't had people leaving us just for like any bad experience or something of that sort. But we also find it difficult to get good quality people. Let me just put it that way, right? Because there is a lot of shortage. So we will always optimize for how, like you will optimize for how your business should run, right? You wouldn't do something which is unprofitable or unviable at your end. So criteria are set keeping those things in mind. I'm sorry, I know the questions was two front, the steps and the criteria, but I wanted to first answer the criteria part only to make you understand that there is no standard criteria. The criteria depends upon who you are going to. There are investors who have absolutely no criteria, would want to look at anything and everything. There are sometimes criteria may sound very funny to you as well, right? There are groups of networks, for example, they might have criteria in terms of what college you have passed out from. So there could be your college alumnus as a criteria. I know of networks which are also religious in nature. So they will only invest in founders from certain caste or community. I know of networks that will invest only in a certain geography. So let's say, for example, if you are from Calcutta, you will get money, else you won't get money, period. Or if your company is in Calcutta, you will get money, else you won't get money. It is, so those criteria may appear completely random to you. But there is a fair enough idea of why there is it. Somebody who's put in a geographic sort of limitation is because they could add a lot more value for companies that are coming out of those geography or from a certain college, or they have sort of capital available to be invested with a certain mandate, right? Somebody would want to invest only in impact funds. That is because the capital that the fund themselves have also sourced is earmarked for impact investment only. So criteria are specific to who you reach out to. When it comes to the right steps to get funding at an early stage startup, there is only one step, and it is outreach. Go out there, talk to as many people. The more you speak, the more you learn. Take their feedback. Again, please remember, investors give you two things, not just the money. Even if you don't take the money, you take the feedback. One of my favorite founders, actually within my portfolio, so when they first reached out to us, we'd actually sort of denied investing in the company because it didn't meet one of our criteria, as in they had grown beyond. So we actually also have an upper cap in terms of the size of company that we invest in. So they had actually sort of gone beyond that size, and the founder said, "You know what? I don't care, Rohit. If I don't get the money, I still want something out of this conversation. So yeah, give me some advice or give me some connect or some business development network. So you know that the mentality ki aaya hu to kuch leke jaunga. So and that founder actually got, and we were able to get in via a secondary in that company, wherein then our parameters were better. So we ended up actually finding a way of how we can still end up investing with the same founder, because we loved the founder. And that is what matters in an early stage company. Your founder, the conviction of the founder, the confidence of the founder, and the skill set of the founder is what matters. Because at an early stage, you don't have revenues yet, you don't know whether what your customer will ask you to do. You go out there trying to sell item A, getting market feedback, you'll start tweaking, chiseling out bits and pieces, and adding some more bits and pieces basis market feedback. And lo and behold, 6 months later, your product may not look anything, product or service may not look anything like what it was 6 months ago. So your product or service might change, your business model might change, your monetization strategy might change, your market might change. What does not change is the founder of the company. So any early stage investor will always back the founder. So hence I said, even when it goes to valuation, it is what case can you put up? Why are you or your team or your sort of co-founders the best team to be running this? And whether or not you can achieve a market dominating position. It may not be the top one, top two, top three, depending, because some markets you can have like 10 different players. Like in the insurance sector in India, we will still see a couple of more unicorns taking birth over there, even though there are already a bunch of unicorns there. Sector itself is so big, you can't help it, right?
Yes.
In the whole EV space, there is a lot of stuff happening in EV in logistics, right? And of course, it's not going to be one company. There are going to be at least 10 to 20 new large companies. When I say large companies, 1,000 crore plus type of companies being built in logistics segment only using EV. So it's not like you always have to be number one or number two, but you have to then justify that, okay, even if I'm number 10, I am number 10 in a industry wherein even number 20 has a 1,000 crore market share. So being number 10 puts me at a much better position relative to being number one in an industry that has a potential of 50 crore top line only. So one needs to understand that as well.
Yes, very true, and great insights. But looking at time, last one or two questions we may take. One question which I just received
Yeah.
was like, can we get some specific websites or links where we can know the funding or interested people so that these guys can follow that?
There are quite a few, as in, okay, so I'll try to name a few just for the interest, but there are many more. So don't restrict yourself. A simple Google search would show you. The problem is people don't know what to search. Yeah, so understand, right? So you have angel investors. You could look them up, let's say, on platforms like Angel List, Let's Venture, India Angel Network, and so on and so forth. You get individuals who can invest. You have these networks themselves who act as a liaison between you and the investors, who help you raise money, right? And I've named a few. There are many more, many more. As in, we've worked with at least 10. I can think of at least 20 to 30 names, and I'm sure there are about 100 odd networks or such, where a group of angels come together and invest, right? LinkedIn is a great source to reach out to people in the similar or adjacent industry. Look at who you are disrupting, whether those people would want to invest in you as a part of their own de-risking strategy. Early stage funds go out of their way to market themselves. So even if you just look up early stage VC funds in India, you will get a list of list prepared. I remember seeing one a couple of years ago being published by inc42.com, or you have those news outlets also, Your Story, so on, et.com, and the likes. What we could also look at is very well is look at who are your competitors, where have they received their funding from. If not direct competitors, you will definitely have some sort of indirect competitors. Look at where those guys have received their funding from. Try tapping into similar channels, right? So you need not reinvent the wheel, right? Half of the work is already done. So you can always learn from others' mistake, and then because that way what happens is you already sort of have zeroed in on people who are more likely to say yes. If you do a blanket search, again, oh, by the way, and one very, very important thing. Sorry, I'm going back to the previous question of steps for early stage funding. So step one, as I said, is outreach. Step two is don't stop the outreach. So it's a numbers game. You have to understand, right? So if let's say if there are people like me, there are 100 people like me, and the same 100 company have applied to all 100 of us. Then let's say if there is everybody at random investing in one company each, then the chances are everybody gets invested. But then each founder there have had to reach out to 100 investors in order to get that one deal. More often than not, what I see happening is founders give up after 5 conversations, 7 conversations, n number of conversations. So there are very, very like extreme examples, right? So Airbnb, for example, it's a very commonly cited, right? They raised their seed funding from the 57th or 56th investor that they approached. They got rejected 50 plus times. And you know where the company is right now. It's a NASDAQ listed entity, right? Multi-billion dollar organization. Got rejected 56 times before, like more than 50 times. Okay, number maybe here or there by a couple, but got rejected more than 50 times. They only succeeded because they still persevered and were at it. So please don't stop your outreach. And as I said, if somebody like me who's sitting in Pune and who's saying that, I invest in 1% of the companies I look at, if you just put yourself on the other side of the table, which means as a founder, I need to approach at least 100 investors at an early stage. Now, if I were to ask founders, okay, can you show me 100 conversations that you've done before having claimed ki humko to koi funding deta nahi hai? Trust me, like 99% of the founders cannot show that. But so it's also about persevering and continuing to go look at more. It's a numbers game. You have to reach out to a wide number of people. It's exactly same as sales. When you have to do your initial sales, first 5 sale karna is the hardest part. Correct? Why? Because you have to meet the widest audience for it. Take feedback from many. Most of the people giving you feedback will not end up giving you their money. But take that feedback, because with that feedback, with the improvement that you can do with that feedback, you can actually create something for which somebody else might give you money. So do know that. So please persevere, and it's purely a numbers game. The more outreach you do, the better it is.
True, very true. So like listening at this session, it was very insightful and a different perspective to look at things. So when you say like if you get 100 applications and you choose one, that means one guy has to try 100 is the other side.
That is a simple corollary
Right.
to that, right? I am not saying everybody has to do 100, right? Because maybe
Depends.
I was the first application of the guy I selected. So it's not ki har ek ke liye 100 apply hota hai. But the thing is, if one knows that, then don't give up at least before 100. And I know 100 is a big number, but try. You will get some feedback. Like if up till 50 you are getting the same feedback and it's not yet incorporated, which means there is a issue with the feedback loop. You are not absorbing the corrections that you are getting.
Great. Great session altogether.
Yeah, there is one last question. I think I
Yes.
believe I've also answered all the questions from the list that you'd sent except one, which is how to protect your startup's innovation or idea while pitching for raising funds. So one
if
has
you can please put light on it,
because this is a sensitive topic, and I have seen a lot of founders come up to us, and at times they are also hesitant to fully say what they are doing. And my answer to them is very simple, right? As a professional investor, I am not there to run your business. My business is investing. I am building my skill set doing that, right? If I just knew what you were to do, and if I am a better executor than you are for your business, right, then you should contemplate whether you are the one who should be running the business to begin with, because an idea is not worth anything, and like an idea is not worth the paper it is written on. if it is not executed. So what you need to think of is, if sharing the idea, you might end up losing your moat. Like, again, I'm not saying reveal your trade secrets, reveal your software codes threadbare line by line, but sharing the concept and the idea, if just by doing that you believe you are losing out on value, then I'm sorry, then probably you are not sitting on any value, because you are not the right person to be encashing that value. Again, goes back to what I said before, right? Why are you the best person to be running this idea? And if you are the best person to be running this idea, you could go around sharing this idea to the entire world and just announce, this is what I'm going to do. I'm the best one to do it. I'm going to do it. Bye. Why even hide? If you feel the need to hide, I would recommend don't take money from such people. Simply because आज नहीं तो कल आपके दिमाग में वो doubt रहेगा. You will not be fully transparent with them, and that lack of transparency at the investor side would be taken in a very different direction. You might not be wanting to shelve out your technical secrets, but the investor might think, yes, मेरे से चीजें छुपाता है. So this guy is not fully honest with me. Maybe he's also doing that on the financial side. Maybe he's also doing that on the compliance side. Maybe he's also doing that on the operations side. So suddenly that thing explodes. So my simple sort of litmus test is, if you feel unsafe sharing your idea fully with a prospective investor, don't approach that person, period. And then look at your universe of people you are able to approach. And if you feel that, oh, you cannot share it with anybody, which means then you are not the right person to be running the business. So yeah, I believe Pradeep has put up the contact details for AIC-Pinnacle as well. And it's 5:01. So yeah, I think I'd wrap up the Q&A session.
Very much on time. We are very much on time. So yes, I think if people want to connect you, can we paste your email ID as well?
I actually would prefer if people could reach out to me on LinkedIn, and I can just be looked up on LinkedIn as Rohit Goyal. I prefer that. I am a bit slow on the whole email thing, just because my inbox gets bombarded too much. So feel free to reach out to me over LinkedIn, or like, even my email ID is actually there on our website. I don't mind actually typing my website to everybody. Yeah. Oh, okay.
Participants can reach out and we can roll out questions to Rohit.
Okay. So I have actually just shared my website to the host. So I'll just request them to share it with the audience.
Yes.
So as I said, there is a direct apply now section over there. So you could apply to us for funding directly as well. Not a problem. There's a comprehensive form, so one has to be prepared before applying to us. Simply, again, another way for us to filter out is we put the burden of application on the founder. And if they are not willing to take the effort, why should we take the effort to sit and evaluate their business? Correct. So even though it might sound a bit harsh, but that actually acts as a filter for us. So sometimes you need to realize that, investors also set some soft filters which are not directly out there, not listed out in black and white. So yeah, I encourage everybody, you can reach out to us. My email ID is there on our website also. It's rohit@windows.capital. But LinkedIn, I am much faster to respond as compared to emails.
Great.
Lovely.
Yes. So yeah. I assure that everyone was benefited by this session, absolutely. And also these guys will may get in touch with you. And I think Dr. Saurabh has one more question. So yes, Doctor.
Hello, sir. Can you please share your number and sir number?
I'm sorry.
Yes, just shared in the
from. Yeah, I'll share my. As I said, if you reach out to me on LinkedIn, trust me, you can reach out directly to me.
Yeah, please share me your LinkedIn profile here and share the sir number to AIC.
We will help you in that. Actually, we are running out of time. But really, it was insightful session. And thank you, Rohit, for your inputs are definitely for startup. Initially, there was very trouble because of spam, but we are very sorry for that.
Not a problem. It's perfectly okay. Okay. Thank you so much, Pradeep,
Yes.
Akshay, and entire team at AIC, and of course the audience for having come here. I wish you all have a nice weekend ahead.
Yeah, thank
Thank
you.
you.
Thank you all the
Thank you very
participants.
much.
Thank you, Rohit. Again.
Thank you, everyone. Please, everyone, please feel free to reach out to us if there are any things we can be of help. So that's it from our side, and we'll keep meeting for such sessions ahead. Thank you very much. Happy weekend.
Thank you, guys. Bye.
Bye. Bye.